The year is almost over, yet the markets keep surprising. Yesterday's US GDP data printed the fastest growth in 2 years, ladies and gentlemen, driven by AI investments, strong corporate profits, and resilient consumer spending. But price pressures also rose alongside with strong growth, with PCE at 2.8% level, but happily less than expected and less than penciled in by analysts. So equities rallied yesterday on the back of strong earnings and strong spending, though the rally was narrow and mostly benefited big technology. The US dollar eased on the other hand, pushing gold, silver, and copper to fresh all-time high levels. In all cases, it feels like Santa is on his way with his final gifts this year, and what happens next year will be, well, next year's problem. So welcome to Swissquote's daily Market Talk. I'm İpek Özkardeşkaya. We are December 24th, and everything that I will say in this video is based on my own opinions, and this is not financial advice. What a season finale, guys. The year is almost over. Traders are partly already on vacation. Investors have largely reshuffled their portfolios. Many actually closed their positions to call it a year. Trading volumes are coming in thin, around 30 to 35% lower than past month's average, yet the year keeps on giving. Yesterday, the US announced a set of GDP data that blew everybody's mind. The US economy grew 4.3% in the third quarter of this year. I will repeat that again. Endured and thus, in the middle of the trade tensions, tariffs, uncertainties, geopolitical chaos, job losses, and you name it, the US economy managed to grow 4.3% quarter on quarter. That was the fastest growth in the past 2 years and was obviously driven by AI investments. That's a given. But it was also driven by strong corporate profits that jumped 4.4% last quarter and very, very strong consumer spending as well. Sales were up by 4.6% on the quarter. Naturally, the price pressures also flared up, with the PCE prices jumping to 2.8% on the quarter from 2.1% printed a quarter ago, along with the fact that 2.8% growth in PCE prices last quarter was also a bit less than the 2.9% expected by analysts, keeping the Fed hawks at bay. Happily, also the industrial production and consumer confidence data from the US were also weak enough to balance out the euphoric growth numbers and that unideal inflation figures. But still, and to show that the market is still functioning some way, the US 2-year yield that best captures the Fed expectations jumped past the 3.5% level after the sight of that strong GDP and PCE data. The probability of a January Fed cut fell to 15% from around 20% before the data release, and activity on Fed funds futures prices a June rate cut at 80%. Do you think equity investors cared? Well, yes, they did care. Major equity indices in the US rallied on the back of the strength of the corporate earnings and the US consumer spending, but the small cap index, for example, underperformed its bigger peers as smaller companies saw the Federal Reserve rate cuts being kicked down the road in 2026. The S&P 500's equal weighted index actually fell despite gains in the broad and normal weighted S&P 500 index, meaning that yesterday's equity rally was shouldered by the technology stocks and didn't necessarily go in the direction of that rotation trade. You know, the rotation from technology to the non-technology pockets of the market that could provide a cushion to an eventual technology sell-off next year. So gains were on the menu of yesterday, but these gains in equities mask a step back from the optimistic scenario for next year, and the rising index points obviously came with the rising risk of a reversal in these latest gains. The US dollar, on the other hand, eased, and it eased despite the more hawkish Federal Reserve bets after the strong GDP print, suggesting that the pressure on the US dollar is so strong that even a GDP print of 4.3% for the US couldn't bring the bulls back to the market. And the soft US dollar obviously sent gold, silver, and copper prices to fresh all-time high levels as well. One more time this year, gold traded past the $4,500 per ounce mark. We can say it has been a golden year for these three metals. The yellow metal, gold, renewed record more more than 50 times throughout this year and added more than 70% to its value. Gains in silver have been even more impressive than that. The grey metal rallied 150% since January. 150%, guys, on the back of this famous debasement trade, a macro investment theme built around the idea that fiat currencies like US dollar, euro, sterling lose their purchasing power over time because of heavy government debt, persistent deficits, loose monetary policy, and financial repression, which means that rates are being kept below inflation. Add to that the rising demand for silver and copper versus their limited supply, well, you have a pretty clear idea on why these metals have actually done so well in such a disruptive year for financial markets. So the question that everybody is asking right now is, could this rally run further, or is this also a bubble? Well, the reasonable answer to that question is that the forces that push these metals prices to all-time high levels are still very much in play. Heavy government debt into 2026? Check. Persistent and growing deficits in DM markets? Check. Loose monetary policies and low real yields? Check. Geopolitical uncertainties? Check. Narrow supply and rising demand for these metals? Check. So yes, in theory, the outlook for gold, silver, and copper remains positive for the medium to long run. In the short run, however, there is no doubt that these metals prices have risen too fast in a too short period of time, and a certain downside correction would only be healthy at the current levels. The gold volatility index is on the rise again, suggesting that we will likely see gold prices retreat before we see them continue their journey north above the $4,500 per ounce level. And a potential sell-off in metals could hit silver heavier than gold. The mint ratio, the ratio between gold and silver that historically stands within the 60 to 80 range, is now rapidly falling toward the bottom of that range. It's around 62 today. So if we assume that the mint ratio will remain in the historical trading range, either silver should cheapen versus gold by gaining less in the continuation of this rally, for example, or we will see a correction more sharply to the downside following this rally. So in both cases, the price pullbacks will be interesting opportunities for investors to add gold and silver in their portfolios if it's not done just yet. Traditional investors have around 2 to 5% of their portfolios allocated to gold for diversification purposes, and silver could very well be in that mix. Anyway, it's gently time for me to say goodbye. But before I go, the past few sessions actually suggest that Santa will probably arrive this year, and he will arrive with gifts in his hands. Remember, what we call Santa rally is a market rally during the 5 final sessions of a year and the 2 first trading days of the new year. What can you expect? Well, if history is any guidance, you could expect around 1.5% gains during this period. And after that, well, the reality will probably hit in January, I guess. The first 2 years of the AI boom was about funding. And this is normal because you need to buy the chips and build these data centers to sit your AI models and your applications on them. The third year, so this year, started raising questions among investors about the viability of these models and profitability of the investments and the revenue potential of all of these AI investments. And the fourth year, so next year, will likely be about awakening and a clear emergence of winners and losers of the AI environment. Those who will be able to turn their investments into actual dollars and those who won't be able to do so. So on this note, and for one last time this year, I think that some pockets of the technology market are probably in a bubble, but not all, and next year's earnings will be more about digging into where revenues comes from than being blindly impressed by shiny figures. So first thing to watch next year is whether OpenAI's planned chatbot ads can actually generate enough revenue to give investors confidence and peace of mind that their payments to the rest of the AI circle will actually realize and there won't be any problem. I genuinely believe that it will be fine. So on that positive note, I'm İpek Özkardeşkaya, and this was the last episode of Market Talk of this year. I actually prepared 2 more episodes for you guys, one looking back at 2025 and one looking forward to 2026. We will be also publishing our traditional year-end talks about cryptocurrencies and structured products and passive income shortly as well. My year-end talk with NFG's Glenn Coxon is unfortunately pushed to next year, January, Harry, as he was unfortunately sick the day we shot the videos and couldn't join that day. But all this will be coming shortly as well, don't worry. I can't thank you enough in the meantime for all your support and all your messages during the entire year. Your feedback and your comments clearly make these market talks richer and more insightful for everybody. So thank you again for joining me. Thank you for joining us. As always, do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next year, and until then, I wish you a Merry Christmas and a Happy New Year.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.